Ind AS 19 Employee Benefits. This standard shall be applied by an employer in accounting for all employee benefits other than share-based payment benefits. In case of share-based payment benefits, Ind AS 1 or 2 is applicable, and reporting by employee benefits plans. For these two, Ind AS 19 is not applicable. For all other employee benefits, Ind AS 19 is applicable. Next, employee benefits are of four types. First one, short-term employee benefits. Second, post-employment benefits. Third, other long-term employee benefits. Fourth, termination benefits. Here, employees includes directors and other management personnel. First one, short-term employee benefits. What do you mean by short-term employee benefits? Short-term employee benefits means employee benefits other than retirement benefits, which are expected to be settled before 12 months after the end of the reporting period in which the employee renders service. Short-term employee benefits includes wages and salaries, paid annual and sick leave, profit sharing and bonuses. Next, recognition and measurement of short-term benefits. How these short-term benefits will be recognized? Debit expense or assets if amount already paid exceeds amount of benefits. Recognize that excess as an asset, that is prepaid expense, to the extent prepayment will lead to reduction in future payments. Credit will be given to cash or liability. Liability, if the amount is unpaid, recognize the expense as liability. Here, the amount will not be discounted because it is short-term benefit. So there will be no discounting. If employee was involved in construction of asset or inventory, the expense will form part of cost of asset as per Ind AS 16 or cost of inventory as per Ind AS 2. Next, short-term paid absences. Short-term paid absences are of two types: accumulating paid absences, non-accumulating paid absences. Accumulating paid absences. These are absences that are carry forward and can be used in future periods. If the employee is not able to use them in current period, they can be either two categories, either vesting, non-vesting. Vesting, in this case, employees are entitled to a cash payment for the unutilized leaves. And in case of non-vesting, in this case, employees are not entitled to a cash payment for unused leaves. An entity shall recognize and measure in the current year the additional amount that the entity expects to pay as a result of unused paid leaves that has accumulated at the end of the reporting period. Next, non-accumulating paid absences. These are the absences that do not carry forward and they will lapse if the current period's leave encashment is not used in full by the employee. They do not entitle employees to a cash payment for unused entitlement on leaving the entity. Therefore, entity shall not recognize any liability or expense pertaining to this. Next, profit sharing and bonus plans. Expected costs of profit sharing and bonus plans shall be recognized only when the entity has a present legal or constructive obligation to make such payments as a result of past events, and a reliable estimate of the obligation can be made by the entity. An obligation under profit sharing and bonus plans results from employee service and not from a transaction with the entity's owners. Therefore, an entity recognizes the cost of profit sharing and bonus plans not as a distribution of profit but as an expense. If profit sharing and bonus plans are not settled before the 12 months after the end of the reporting period in which the employees render the related service, those payments are considered as other long-term employee benefits. So they will be considered as other long-term employee benefits. Next, post-employment benefits. Post-employee benefits means employee benefits other than retirement benefits and short-term employee benefits. They are payable after the completion of employment. Post-employment benefit includes retirement benefits such as pensions, lump sum payments on retirement, and other post-employment benefits such as post-employment life insurance and post-employment medical care. Post-employment medical care. Classification of post-employment benefits plans. It is divided into two categories: defined contribution plans, defined benefit plans. In case of defined contribution plans, the entity's obligation is limited to the amount that it agrees to contribute to the fund. Example, statutory provident fund, mediclaim, etc. Actuarial risk and investment risk will fall on the employee and not on the entity in case of defined contribution plans. In case of defined benefit plans, the entity's obligation is to provide the agreed benefits to current and former employees. Example, gratuity, medical reimbursements, etc. Actuarial risk and investment risk will fall on the entity and not on the employee in case of defined benefits plans. Next, what is meant by actuarial risk? It is the risk that benefit, that is liability for an entity, amount will be less or more than expected. It is the actuarial risk. What is investment risk? It is the risk that investment amount would not be sufficient to pay the liability. It is the investment risk. How to account for defined contribution plans? The entity shall recognize the contribution payable to a defined contribution plan by following journal entry: employee benefit expense account debit to cash or liability if unpaid. Obligation or liability if falls due within 12 months from the end of the reporting period are measured on an undiscounted basis. Discounting is done when the obligation falls due after 12 months after the end of the annual reporting period in which the employees render the related service. Accounting for defined benefits plans. Here, projected unit credit method PUCM is used by the entity to determine the present value of its defined benefit obligations and related current service cost and past service cost. Defined benefit plan includes these terms: current service cost, defined benefit obligation DBO, current service cost CSC, interest cost, actual gain or loss on defined benefit obligation, past service cost, plan assets, expected return on plan assets, actual gain or loss on plan assets, curtailment and settlement, net defined benefit liability or asset, net interest expense or income, asset ceiling, remeasurement gain or loss. Next, there is an example given here pertaining to this defined benefit plans. Consider this example. XYZ Limited hired Mr. Akash for a salary of 10 lakhs per annum. He is entitled to gratuity, which will be 1% of the final drawn salary per annum into number of completed years of service. Expected growth rate, that is increment in salary each year, will be 10%. Expected employment period will be 5 years. The discount rate is 10%. In such a case, gratuity payable will be 1% of the final drawn salary per annum into number of completed years of service. Final drawn salary will be 10 lakhs into 1.10 whole to the power 4 because there is an increment for 4 years. In such a case, final drawn salary will be 14 lakhs 64,100. Here, employee will get only 4 increments, not 5, as he will get the first increment in second year beginning. So in 5 years, he will get only 4 increments. Therefore, gratuity payable will be 1% into 14 lakh 64,100 into 5 years. That is 73,200. Expense of 73,200 is for 5 years. Therefore, it will be booked each year because even if it is payable after 5 years at the time of expected retirement, it is earned by employee by working for 5 years. Also, we follow accrual basis of accounting and not cash basis. Therefore, expense to be recognized each year will be 73,000 divided by 5, which will be 14,640 each year. So, year 1 cash flow will be 14,640 payable after 4 years, as we are booking expense at the end of year 1. The discount factor is 1 by 1.10 whole to the power 4, which comes to 0.683. The amount will be 10,000. That is cash flow into discount factor, 10,000. So on, we will do for up to 5 years. We discounted the expense to be booked each year and they are to be payable after 12 months from the end of the reporting period. The general interest will be at the end of the year 1, booking gratuity expense, current service cost, 10,000 to defined benefit obligation 10,000. Current service cost will be charged to P&L as employee benefit expense. Next, current service cost. It is the increase in present value of defined benefit obligation resulting from employee service in the current year. Defined benefit obligation. It is the present value of expected future payments required to settle the obligation resulting from employee service in the current and previous periods. At the end of the year 2, unwinding of discount, the entry will be interest account debit to defined benefit obligation account, which will be 10,000 into 10%, 1,000. This interest cost will be charged to P&L account as employee benefit expense. Booking of gratuity expense for the year 2. The entry will be current service cost account debit to defined benefit obligation account 11,000. Here this is 11,000. So on we will do the procedure. Next, interest cost on defined benefit obligation. It is the increase in value of defined benefit obligation because of passes in time. How to calculate the interest cost on DBO? Opening present value of DBO into discount rate. At the end of the year 3, we need to unwind the discount. The entry will be interest cost account debit to DBO. That is 2,200. How 2,200? 10,000 plus 1,000 plus 11,000 into 10%. We will get the interest cost. It will be charged to P&L account as employee benefit expense. Booking of gratuity expense for year 3. Current service cost account debit to defined benefit obligation account 12,100. Next, at the end of year 4, unwinding of discount, interest cost account debit to defined benefit obligation account 3,630. How 3,630? 36,300 into 10%. That is opening balance of opening DBO balance. Next, booking of gratuity expense for the year 4. Entry will be current service cost account debit to defined benefit obligation account 13,330. 13,310. 13,310. Here 13,330. 13,300. So it may be due to rounding off. At the end of year 5, unwinding of discount, the entry will be interest account debit to defined benefit obligation account. Entry will be 5,324. How 5,324? 53,240 into 10%. Booking of gratuity expense for year 5. Current service cost account debit to defined benefit obligation account 14,640. 14,640. Next, defined benefit obligation balance as at the end of 5th year. The 5th year, the defined benefit obligation balance will be 73,200 approximately. On payment of gratuity, the entry will be defined benefit obligation account debit to cash or bank 73,200. The above example is solved assuming there are no changes in actuarial assumptions and no additional adjustments are needed to reflect the probability that the employee may leave the entity at an earlier or later date. Actuarial gain and losses on defined benefit obligation. These are the changes in present value of a defined benefit obligation resulting from actuarial assumption change, experience adjustments, etc. Like future salary increment, number of years of service change, discount rate change, mortality rate change. If change in assumption leads to increase in present value of defined benefit obligation, entry will be actual loss on defined benefit obligation account debit to defined benefit obligation. Actual loss on defined benefit obligation will be transferred to OCI NR, other comprehensive income NR, non-reclassified to PNL. If changes in assumption leads to decrease in present value of defined benefit obligation, entry will be defined benefit obligation account debit to actuarial gain on DBO, defined benefit obligation. Actuarial gain on DBO, defined benefit obligation, will be transferred to OCI NR. Next, past service cost. These are the changes in present value of defined benefit obligation for employee services in prior periods resulting from a plan amendment. Example, gratuity of 1% was increased to 3% or a curtailment. Curtailment means a decrease in the benefit. If amendment leads to increase in present value of defined benefit obligation, the entry will be past service cost account debit to defined benefit obligation account. Past service cost will be transferred to P&L as employee benefit expense. If amendment leads to decrease in present value of defined benefit obligation, entry will be defined benefit obligation account debit to past service cost. Past service cost will be transferred to P&L as employee benefit expense. Plan assets. Plan assets. These are the assets which are created, that is invested exclusively to fund the defined benefit obligation. These assets can be used to settle DBO only and are not available to entities own creditors, even in case of bankruptcy, and cannot be returned to the reporting entity except when plan assets are in excess of defined benefit obligations. Plan assets should be measured at fair value. For amount contributed or invested in plan assets, the entry will be plan assets account debit to bank account. For withdrawal of funds from plan assets to pay the benefits to the employee, entry will be bank account debit to plan assets. Expected return on plan assets. Under Ind AS 19, the rate of expected return would be the same as discount rate used to find the present value of defined benefit obligations. It is calculated as plan assets into discount rate, that is expected rate of return. Journal entry will be plan assets account debit to interest income account. Interest income will be transferred to P&L account as employee benefit expense or income. Actual gain or loss on plan assets. This is the return on plan assets excluding expected return. Since plan assets are to be valued at fair value, there will be a difference between expected return and actual return, which is known as actual gain or loss on plan assets. If actual return is greater than expected return, then there will be actual gain. The entry will be plan assets account debit to actual gain account. Actual gain will be transferred to OCI NR, not reclassified to P&L. If actual return is less than expected return, then there will be actual loss. Entry will be actual loss account debit to plan assets. Actual loss will be transferred to OCNR. Actual return on plan assets. Actual return on plan assets equals to expected return on plan assets plus actual gain on plan assets minus actual loss on plan assets. Actual return comprises of the following. First, expected interest income or dividend income plus or minus realized gains or losses plus or minus unrealized gains or losses minus cost of managing plan assets minus taxes. Next, curtailment and settlement. What is curtailment? Curtailment arises when an entity significantly reduces the number of employees covered by a plan. A curtailment may arise from closing of plant, discontinuance of an operation, termination or suspension of a plan. Settlement. A settlement occurs when an entity settles defined benefit plan before the due date. Example, defined benefit plan is of 1 lakh and it is settled for 90,000. This is the settlement. The journal entry in case of curtailment will be defined benefit obligation account debit to gain on curtailment or past service cost. This gain on curtailment or past service cost will be transferred to P&L as employee benefit expense. Next, in case of curtailment, in case of settlement, the journal entry will be journal entry for to withdraw funds from plan assets. Entry will be bank account debit to plan assets 90,000. Journal entry to settle defined benefit obligation. Defined benefit obligation 1 lakh to bank account 90,000 to gain on settlement 10,000. Gain on settlement will be transferred to P&L as employee benefit expense. Next, net defined benefit liability or asset. Under Ind AS 19, the plan assets and present value of defined benefit obligations are netted off and presented in the balance sheet as net defined benefit asset or liability. If present value of defined benefit obligation are greater than net plan assets, then it will be net defined benefit liability, also known as net deficit, which is to be presented on liability side. If plan assets are greater than present value of defined benefit obligations, then it is net defined benefit asset, also known as net surplus, which is to be presented on asset side subject to asset ceiling. Next, net interest expense or income. Under Ind AS 19, interest rate is same for booking interest expense, that is unwinding of discount on defined benefit obligation, and booking interest income, expected return on plan assets. If interest expense is more than interest income, then in P&L under employee benefit expense, net interest expense, that is interest expense less interest income, will be shown. Next, asset ceiling. If plan assets are greater than defined benefit obligations, that is net defined benefit asset, then excess should be recognized as an asset if and only if entity has the right to recover such excess in the form of refunds, or entity can reduce its future contributions to the plan. Asset ceiling is the maximum amount that is available in the form of refunds from the plan or reductions in future contributions. Net defined benefit asset is the lower of plan assets less defined benefit obligations and asset ceiling. So how to calculate net defined benefit asset? It will be lower of plan assets less defined benefit obligation and asset ceiling. This means the net defined benefit asset, net surplus, to be shown in the balance sheet should be restricted to asset ceiling. If the surplus is greater than the asset ceiling, and the difference would be adjusted in other comprehensive income, not reclassified to P&L as a remeasurement loss. In case of net defined benefit liability, net deficit asset ceiling is irrelevant. Example, DBO 1 lakh, plan assets 1 lakh 10,000, asset ceiling 4,000. Net defined benefit asset, net surplus before adjustment of asset ceiling is 10,000. However, as the asset ceiling is 4,000, an adjustment should be made for 6,000. That is 10,000 less 4,000. Net defined benefit asset, net surplus after adjustment of asset ceiling will be 4,000. Entry will be remeasurement loss account debit 6,000 to plan assets net surplus. Remeasurement loss will be transferred to OCI, not reclassified to P&L. Remeasurement gain or loss. It comprises of actual gain and losses on defined benefit obligations and actual gain and losses on plan assets and any change due to asset ceiling. Defined benefit plan presentation summary. How it is presented. In statement of P&L, it is a draft. In P&L, we will show employee benefit expense, current service cost, plus or minus increase or decrease in past service cost due to plan amendment, curtailment, or settlement, plus or minus net interest expense or income. That is interest expense on defined benefit obligation less interest income on plan assets. We will get a profit or loss. Next, OCI, which is not reclassified to P&L, remeasurement gain or loss. That is plus or minus actual gain and losses on defined benefit obligation plus or minus actual gain and losses on plan assets and minus changes, that is loss due to asset ceiling. Next, balance sheet. Liability, net defined benefit liability, defined benefit obligation less plan assets. In case of assets, defined benefit, net defined benefit asset, plan assets less defined benefit obligation. We will get net defined benefit asset before asset ceiling adjustment minus changes due to asset ceiling. We will get net defined benefit asset after asset ceiling adjustment. Ind AS 19 does not specify whether an entity should distinguish current and non-current portions of assets and liabilities arising from post-employment benefits. Next, how to calculate defined benefit obligation. Format for calculating defined benefit obligation. Opening defined benefit obligation plus interest expense plus current service cost plus increase in past service cost minus decrease in past service cost minus gain on curtailment or settlement minus benefit paid minus actual gain on defined benefit obligation plus actual loss on defined benefit obligation. We will get closing defined benefit obligation. Plan assets. How to calculate plan assets. Opening plan assets plus expected return on plan assets, that is interest income, plus contributions to plan assets minus withdrawals to pay benefits plus actual gain on plan assets minus actual loss on plan assets. We will get a closing fair value of plan assets. Next, attribution of current service cost to each year of service. The attribution of a current service cost to a year of service should be done only if the unit of services rendered in that period gives rise to an additional unit of benefit to the employee, that is a liability for entity. If employee's service in later years gives rise to higher level of benefits than the earlier years, an entity is required to attribute benefits over a straight line basis over the eligible period. Eligible period starts from the date when service by the employee leads to benefit accrual and ends on the date when further service by the employee does not give rise to any additional benefit entitlement. Special plans, following are the special plans, multi-employer plans. Multi-employer plans. These are the plans that pool the assets contributed by various entities, not group companies, and use those assets to provide benefits to employees of those entities. These can be defined contribution plan or defined benefit plan based on terms. Group plans. Group plans that share risks between entities under common control. For example, a parent and its subsidiary. Usually, these are defined benefits, but it's in some cases it may be defined contributions based on terms. State plan. State plans are established by legislation to cover all entities and are operated by national or local government or another body. Example, Employee Provident Fund. These are usually defined contribution plans, but in some cases it may be defined benefit plans based on terms. Next, insured benefits. Entity obtains insurance from the insurance company towards its retirement benefit plans by paying insurance premium. If entity has no obligation to pay beyond premium amount, then it will be defined contribution plan. Otherwise, it will be defined benefit plan. Other long-term employee benefits. Other long-term employee benefits. These are the employee benefits which are expected to be settled after 12 months from the end of the reporting period. For example, long-term paid absences such as sabbatical leave, jubilee hour, other long service benefits, long-term disability benefits, profit sharing and bonuses, deferred remuneration, etc. Accounting. Accounting of other long-term benefit is same as defined benefit plan. Under post-employment benefit, that is using projected unit cost method, except remeasurement gain or loss, which will be recognized in P&L and not in OCI. The reason being measurement of other long-term employee benefits is not usually subject to the same degree of uncertainty as the measurement of post-employment benefits. Termination benefits. Termination benefits results from either an entity's decision to terminate the employment or the employee's decision to accept an entity's offer of benefits in exchange for termination of employment. Employee benefits plan or termination benefits if they both result from an entity's decision to terminate an employee's employment and are not on conditional on future service being provided. Example, voluntary retirement scheme, retrenchment scheme. Termination benefits do not include employee benefits resulting from termination of employment at the request of the employee without an entity's offer or as a result of the mandatory retirement requirements, because those benefits are post employment benefits. Accounting. An entity is required to recognize a liability and an expense for termination benefits at the early of the following dates: when the entity can no longer withdraw the offer, or when the entity recognizes cost for a restructuring, which is within the scope of Ind AS 37, whichever is earlier. If the retirement benefits are expected to be settled after 12 months after the end of the reporting period, discounting should be applied. Only that part of the benefit which is exclusively linked to termination can be recorded as termination benefits. If any part of the compensation is linked to employees' future service, then that part should be recorded as service cost and not termination cost. Example on termination benefits. An entity plans to close a factory in 10 months and terminate the employment of all the remaining employees. Because the entity needs the expertise of employees at the factory to complete some contracts, it announced a plan of termination as follows. Each employee who stays and renders service until closure of the factory will receive rupees 30,000. Employees living before closure of the factory will receive 10,000. There are 120 employees at the factory. At the time of announcing the plan, the entity expects 20 employees will leave before closure. Therefore, the total expected cash outflow under the plan are 32 lakhs. That is 10,000 into 20 plus 30,000 into 100. 10,000 means employees living before closure of the factory will receive 10,000. How many employees? 20. Plus, and each employee who stays and renders service until closure of the factory will receive 30,000. How many employees? 100. The entity accounts for benefits provided in exchange for termination of employment as termination benefits and in exchange for service as short-term employee benefits. Termination benefits. If benefit provided in exchange for termination of employment is 10,000, this is the amount that an entity would have to pay for terminating the employment, regardless of whether the employee stays and renders service until closure. Therefore, the entity recognizes the liability of 12 lakhs, 120 into 10,000 for termination benefits at the earlier of when plan of termination is announced, or when entity recognizes the restructuring costs associated with the closure of the factory. Next, in case of short-term employee benefits, the incremental benefits that employees will receive if they provide services for full 10 months are in exchange for services provided over that period and will be accounted as short-term employee benefits to be settled within 12 months from the end of the reporting period. In this example, discounting is not required. Because of short-term in nature, discounting is not required. So an expense of 2 lakhs, that is 20 lakhs divided by 10, is recognized each month for 10 months with a corresponding increase in liability.